Right. Today I want to talk about what is the Trump put, right? Now, the Trump put is a term coined to describe a market phenomenon where the US President Donald Trump, when faced with significant market um, uh, downturn or investor backlash, pullbacks, or often potentially harmful policy decisions or soften, potential harmful policy decisions, especially tariffs and trade threats to avoid further economic damages. We have seen him doing it in his first term already, and the second term he's doing exactly the same thing again. So this Trump put here, this term here is modeled on a concept of a Fed put, where the Federal Reserve is expected to lower interest rates or inject liquidity during market stress. So in essence, the Trump put is not a formal policy tool, but a psychological safety net traders and investors have come to anticipate. Now, with the Trump put, the floor is metaphorical. It's the level of stock market pain at which Trump pivots to prevent further damages. So this time around, actually, what triggered the most recent Trump put? Now, the most recent Trump put was triggered in early April 2025, following what the White House called Liberation Day. On April the 2nd, Trump announced sweeping tariffs, right? So what he announced on that day was a 145% tariff on Chinese imports, covering over 500 billion in goods, high levies on imports from allied countries like Canada and Mexico, and threats of further duties on European car makers. So what happened next was the market reacted with violent disapproval. The S&P 500 plunged by over 16% just 3 trading days, falling from 1690 to a low of 5115, wiping out months of gains, right? Bond yields remain elevated, with the 10-year US Treasury holding above 4.25%, signaling deep investor anxiety. Retailers and manufacturers were among the worst hit as fears of rising costs and supply chain breakdown surge. Now, behind the scenes, Trump was also facing pressures from CEOs of Walmart, Target, and Home Depot, who warn of empty shelves and inflation spikes. Now, this is being further explained by those economies that are actually monitoring the ports, and they're not seeing any ships coming in. So this kind of warning is, in fact, very, very real. It will take some time before the supply chain is able to, the retailers is able to work out a better supply chain. Now, advisors like Treasury Secretary Scott Bessent, who urged the president to avoid destabilizing the economy before the elections, these are also pressures, that the behind the scenes Trump is facing, because he's saying, like, you know, you just can't really push that hard that much, just have to be careful. And finally, there are also fears of consumer backlash as prices begin climbing. So basically, with these pressures, just days after Trump reversed course. Now, on April 7, he delayed implementation of the majority of tariffs by 90 days. By April 22nd, during a White House press conference, President Donald Trump announced that the steep tariffs on Chinese goods, which was set at 145%, would be reduced substantially but not eliminated entirely. This statement followed comments by Treasury Secretary Scott Bessent, who described the current tariff levels as unsustainable and predicted a gradual de-escalation in the trade war between the US and China. Now, a full policy reversal wasn't announced, but the softened tone and delay were enough to calm the markets. So what happened next was, obviously, the market immediately rebounded. The S&P surged back 10%, stabilizing around 556.50. Volatility VIX fell from 60 to 29 within 7 sessions. Consumer confidence rebounded modestly. This was the clearest modern example of a Trump put in action, where faced with economic fallout and political risk, Trump blinked. Okay, so basically, we want to jump in and study, why the Trump put exists. Now, this Trump put underscores the influence of market performance on presidential decision making. Several factors contribute to this dynamic. First of all is market sensitivity. President Trump closely monitors stock markets indices, often citing them as indicators of his administration's success. The next is policy flexibility. The administration has demonstrated a pattern of adjusting or reversing policies in response to negative market reactions, particularly concerning trade and tariffs. And finally, investors' expectations. Market participants have come to anticipate potential policy reversals when significant downturn occurs, influencing trading strategies and risk assessments. So, how traders can use the Trump put? First of all, watch for rapid steep market drops. Historically, a 10 to 15% drop in major indices over a few days tend to provoke concerns in the Trump administration. If such a drop coincides with a controversial policy like tariffs or Fed attacks, a pivot is likely. Okay, now know this. Under Trump, right? The market is not going to just go one way. It's known to be very volatile, and do expect that. So you can see a lot of this. You may see a lot of this happening again in the future. So this is to prepare you as well. The next part, how can you use this Trump put is to monitor who has Trump's ears. Now, keep track of public statements from key Trump's confidants. The first two, Scott Bessent and Howard Lutnick, often represents market-friendly factions. Now, the second group is Peter Navarro and Stephen Miller. They push harder nationalist policies. A shift in whose advice Trump is acting on can signal the likelihood of a pivot. Okay, so please be on the lookout. Number three, look for retail and industrial stock rebounds. When more Walmart, Home Depot, and logistics stocks start to bounce amid a sell-off, it's a sign investors expect the Trump put to kick in. And finally, consider sentiment indicators like the VIX spiking above 50 also marks panic that often precedes intervention. Okay, so these are the things for you to monitor for the future. Now, first of all, it's not always everything fine and dandy. You also need to know what are the limits of the Trump put, because sometimes markets have to fall sharply and remain depressed before action is taken. There's no guarantee which level will trigger a reversal. It's based on internal political calculus. Now, Trump often blinks but doesn't fully walk back the policy, leaving uncertainty lingering. Now, verbal de-escalation can lift markets temporarily, but traders should beware lack of the follow-through. Okay, that is crucial. So finally, a conclusion, how to trade around the Trump put. First of all, this is real but unreliable. Markets have repeatedly demonstrated that Trump will pivot when equity declines threaten his political capital for traders. This means selling into strength when market is complacent amidst controversial policies. I'll give you an example. After the, and in February, right, Trump introduced these tariffs, and he said that, okay, we are going to he announced he started with Colombia, then moved to Mexico, then Canada, and he said the rest of the world we will announce on April the 2nd. Now, during that period of time, right, the first announcement, we saw market coming down. Then what happened next was that there was a recovery in the market. Now, that recovery was a false recovery. That's why I said selling into strength. At that point of time, if you have stocks that were making money already, it's moving up because the market is complacent, please, you can start taking profits, because what's going to happen next is that for sure April 2nd, it is just only speculation that the tariffs won't be high, but those who speculated that lost badly. So whoever had sold, for example, the tech stocks, I give you the best example will be Apple. We knowing very well that it's affected the most, right? If you have sold Apple by then, you would have really saved a lot of um, money, So these are the reasons why I say selling to strength when market is complacent amidst controversial policies. Now, next thing is to buy the dip if there are high probability set up for reversal, panic plus economic blowback plus business pressure. Okay. Now, staying nimble and treating every bounce as conditional, not guaranteed to last unless policy generally changes. So the next 90 days, If we do not see something concrete, I think it's good for you to protect your trades and start exiting them as well, because you know what's going to happen next. Okay, so these are the things that we need to look out for. So basically in 2025, volatile market traders should treat Trump policy shifts as both catalysts and correction tools. Understand them, anticipate them, but do not bet the house on them. Okay, so with that, I hope you have a better understanding of a Trump put, and that's the report for today.